All right. Okay. So guess we can start with today's discussion. All right. Welcome everyone to our discussion number 307. And today I want to cover the topic that we discussed briefly last week is, how to prepare or, bolster your portfolio if the market crashes. And we've been hearing it in the markets. We have had a great 3 years. I don't know if you're gonna get a great 4 year, fifth year, but generally, market goes up, market comes down. So if you are entering retirement and the market crashes, it we have to take a decision before and make sure your portfolio is positioned um, for the market crash. And of course, we're gonna go through the macro. I'll have some market moving news and look at some charts, look at some companies or any other questions that you may have. Cool. Sounds good. Anyone wants to add anything to for today's discussion? Earnings season hasn't started yet. Next week we will start with maybe financials. So we don't have earnings to discuss just yet. And maybe not the next week, but prior to, yeah, I think week after next, we'll start getting some of the companies that I own in my portfolio, and I guess a lot of you may be owning those same, big, large cap companies. So maybe I think week after next, we'll spend a few weeks discussing earnings results of various companies. All right, sounds good. All right, let's dive in. Okay, so as always, I want to start the discussion with something for our mind. But before that, disclaimer, anything that we discuss here is only for education. So don't go and trade. The idea is to learn from each other, become better in investing, before we commit too much of money. Knowledge is priceless. It's always be useful, if not today, tomorrow, few years later. So try to learn as much as you can. That's my endeavor. Try to learn something every day and also from rest of you guys on the weekend. So appreciate you guys joining over the weekend. All right, so book that I'm currently reading is Winning the Loser's Game. Anyone have read this book already? The reason why I chose this book for my current reading is, in investing, when it comes to mostly amateur investing like us, we are not professional investors. We are kind of DIY investors or retail investors, all are amateur. And in many sports, same case in investing is when it is related to amateur, it's a loser's game, right? Um, it is, we don't have to hit winning shots, we just don't have to make stupid mistakes. And this book is all about if it's a loser's game, how you win that loser's game. So, thought interesting one. And so that's what I've studied on it. Maybe I'll share, some of the pieces of information that I found from this book. But we all know it is difficult to beat the market consistently, even for professionals. So what do we even, I mean, you and I, um, we are no one in the market. I mean, I have, um, you know, I don't know about you, but I sure am not capable enough to beat the market consistently over long period of time. 1 year, 2 year, 3 year, sure. Probably I got lucky. Or maybe I was positioned properly. But when it comes to amateurs or even professionals, it's very difficult to beat the market. So our target should not be to beat the market. Every time when I start for a new year, I'm like, hey, let me make sure I can successfully navigate this year's market and have generate enough money to pay my bills and build wealth, along with it. If you beat the market, that's a bonus, right? But it is, I don't aim for that. Because if I try to aim for that, I'm going to do some stupid mistakes. So here's an interesting chart, the latest PIVA report, which is end of June 2025. Even for the large cap domestic equity funds, more than 50% of US funds have underperformed S&P 500 index. Right? And this, we are talking about the professionals. This, we are talking about the folks from Ivy League colleges who have access to microsecond information available in the markets and have millions of dollars to spend, have army of analysts with them, and have access to every conceivable reports and to the management of the company. They can pick up a phone and call up the investor relation IR guy of a company and can get a meeting with that. Even with all that access, results are not great. In first half of 2025, 54% of equity funds, they have underperformed S&P 500 index, right? And some years it's even worse, right? Most of the time it's worse. I think 54% is actually is a better number to look at. Round numbers, over 1 year, 2/3 of the managed funds will underperform. Over 10 years, nearly 80% of the funds will have underperformed the index. And over 15-year period, 90% of the funds will underperform the index. So when I was saying it's difficult to beat the market, this is what I meant, over a long period of time. And if we are starting on an investing journey, or probably we are investing for the long term, 10, 15, 20, 30 years, it's almost impossible. There are very few people who have consistently beaten the market, and they are known. And why they are known so much, like Warren Buffett, Stanley Druckenmiller, maybe Renaissance Technology, but they don't manage outside money. Why we know these people? Because there are so few of them. Most people, like 90-95% of the funds, will have underperformed if you look at a longer time period. So this book basically talks about how you should structure your portfolio, how you should not commit the mistakes, which generally we as an investor tend to do. Then there were some stats about day tradings, right? And there have been a study done by, this book was published in 2021. And there was a study done by UC Berkeley, a couple of folks. They found that active traders substantially underperform low cost index fund. Taiwan, there are a lot of, I know even in Korea, day trading is very popular. And they looked at a period of for 15 years. Right? So the study that was done in UC Berkeley, they looked at a Charles Schwab account over a 6-year period. And there's a majority of the day traders that had returns which were worse than low cost index fund. Have there been some traders who have made tons of money? Yes, Stanley Druckenmiller is one of them. Jim Simmons, that's what I was mentioning, Renaissance Technologies. They are one of them. They who have like beaten the S&P 500. Majority of us lose. In Taiwan, the data was analyzed over 15-year period. Only less than 1% were able to beat the market's return. And 80% actually lost money. And in Brazil, only 3% made money. Right? And I think, was it 2023 or 2024? There were some stats coming from India. They were no better than like 80% actually losing money. Anyway, I'll share more information as I find in the book. Take it with just a piece of information. I'm not trying to discourage anyone in terms of what they are doing. If you are focused on a day trader, you're making money, stick to what works for you. These are the general stats. There are always outliers in the stats. And if you are one of those outliers, one of those 20% who have been successfully able to made money, etc., maybe that's fine. stick to what it works. So coming back to, so that's around the book. I'll probably share more as I, um, get along further in the book. All right. What happened this week? We had a lot of action. Over the weekend, we had the whole action in Venezuela. So now they're all looking at, what the implication will be on oil prices. And I know last week someone asked the question like, now with Venezuela, should we see the decrease in oil prices and will the stocks of oil companies go down? We never know. At this is why it is so difficult to predict the impact of the macro factors. Even if we had guessed the result properly, how the market will react, the secondary impact, we have no idea. So I think we all guessed correctly that there will be more supply of, could be more supply of oil in the market, but the impact, we thought that the oil company stocks should go down, actually went up. I think all the oil company stocks went up. I guess Chevron and Valero, some of these companies were up like double digits. ExxonMobil. So even if we get the event right, which is that there could be more supply of oil, how the market will react to, we don't know. So anyway, I think administrations indicated that US will basically take ownership of Venezuela oil and we will basically sell the oil. The whole idea is get more oil in US and reduce the current prices. Oil is, I mean, it's already cheaper, but yes, Trump still wants inflation to go down and maybe oil to become further, cheaper than where it is. But so far, Venezuela has actually is responsible only for 1% of oil production. It is because the whole infrastructure of extracting oil is pretty old. It's pretty inefficient. There are huge reserves of oil. In Venezuela, I think that's where and I don't want to get into politics, but the other side of a discussion is we went into Venezuela because it's got 17% of global oil reserves. Right? But the issue is that the tail risk could be, are we setting a precedent for other powerful nations in the world to go and take over or invade other nations because they want some natural resources, especially looking at what's happening between China and Taiwan? Right? I don't know. And I have no capability uh, to even opine on how the politics will work out. But hey, there is a precedent that we have set. So this is an interesting chart on Bloomberg where we are seeing the global supply of oil and the price of oil coming down. I think this week what we ended up, WTI crude was 60 or less than 60, which is pretty low, right? It's almost looking at 5-year, 6-year low, right? We also had a jobs report. We talked about it earlier. Jobs report came in, the growth came in at 50,000, which was below the estimates of 70,000. And also the prior 2 months figure were revised lower by 76,000. And now it's anybody's guess where the 50,000 will end up later on, but it is what it is. It's lower than what the market was expecting, and it means Fed may be a little more willing to cut rates because now if the Fed has got dual mandate, inflation and the full employment, and if the employment situation is a little weak, the only thing Fed can do is to cut the interest rate, maybe to prop up the economy, inject a little more liquidity. And maybe that would result in a companies producing more and hiring more workers. So markets were a little positive in terms of, hey, Maybe we could get a rate cut in January. I don't think we are pricing in. Well, let me just check. CME Fed Watch tool to see if there is any rate cuts being priced for. What happened to the two? Any, if there are any rate cuts for January? Oh, come on. Where is the link for the Fed Watch? I think, let me Google it. CME Fed Watch to probability. Did they move the page? Dang it, I didn't even look into this since last week's. I, no, it's just what I'm missing. Maybe it's broken. I should see the probability over here. In any way, I don't think we were pricing in any rate cut in January, but with the latest job report, maybe we'll see whether we'll get or not. I don't think we're gonna get it. Did anyone hear otherwise on the rate cuts? And the third thing is on the Supreme Court decision. We did not get a decision, despite Bloomberg and the CNBC, we're hopeful that we might get a decision on Friday, but Supreme Court mentioned that nope, we're not getting it, but it probably is going to be imminent in terms of whether all the tariff that administration has imposed since our Liberation Day, is that legally valid or not under the IPA Act. But we also know that administration is looking to for other ways to sustain these tariffs if Supreme Court rules this illegal. But I think the biggest worry is, what if Supreme Court say that you have to, repatriate all the tariffs that you've received? So since April, these are the treasury receipts in terms of the tariff revenue, right? So that's going to be, if we have to give it back, I don't know what Supreme Court might say, or they might say maybe in going in, in future you can't charge these tariffs, these are illegal, but not gonna apply it retroactively. Who knows? We have no idea. But we'll see on what the Supreme Court decision would be. But that's something could bring more volatility into the markets. James is saying Venezuela invasion to protect dollar hegemony, the whole petrodollar stuff. I think I read somewhere saying Venezuela was selling oil not in dollars, but I guess there are a few other political angles in terms of, I think Russia was selling a lot of oil to Venezuela, and then China was importing oil from Venezuela. So by if with one arrow we're trying to shoot two birds, in terms of now we could pressurize Russia to agree to the peace deal with Ukraine, because now we could refuse to buy oil from Russia, and that will cause an impact on Russian economy. And on the other hand, if you don't sell oil to China, which China badly needs, they'll have to find another source to buy the oil. So I don't know what the reality is, but there are a lot of these tinfoil hat conspiracy theories flying around on internet. So one was also that Venezuela was selling oil with maybe doing trade with China on in yuan. So, but I guess even Saudi Arabia did with yuan. So I guess the dollar hegemony is already in downward spiral. Right. So I think the writing is on the wall. It will take a few decades, but the overall share of foreign trade or world trade in dollars have been coming down. It is still the most prominent currency to trade, but but the share is not as much as it was, let's say, 20 years ago. I guess now maybe we are at 65% from 80%. Uh, Alfred Singh changed to this Wednesday. I wasn't sure what was that comment about Friday? Is that the CME website got changed or was there something else? Uh, James is saying rate cuts will fuel further AI investment, more labor displacement. I guess labor displacement due to AI is happening a lot more on the tech side. I'm not sure if we are seeing the other services sector has started to make use of AI and displace labor. But tech sector has been the labor condition in the tech sector has been challenging for last 2 years. So that wouldn't be nothing, nothing new. What else do you see? Housing affordability, right? Trump mentioned that he's gonna ask Freddie Mac and Fannie Mae to buy $200 billion worth of mortgage-backed securities, MBS bonds. And that was positive news for home builders. So if you own home builder stocks or let's say any ETF, I do own because ITB. I mean that was up like 7%. Some of these mortgage servicers, I think like Rocket companies, that was up almost 10%, 9.65%. It's a good news for, I would say, the um, home buying environment. If Freddie and Fannie, they start to buy, they're committing to buy $200 billion of MBS. That means the mortgage rates will come down. And actually, mortgage rates were down like 3-year lows. And it will be good news. So hopefully we will see some revival into the housing market if the rates come down. And that will also mean better for, housing market is one big market where it has a waterfall effect. If you buy a home, then you're going to buy appliances, right? And that's, a dollar gone into buying home will also percolate, a few dollars into other industries. So that's why the home buying is such a, we pay so much attention to in terms of what's happening in the home industry. But so far so good. Market rates did come down, and we saw some jump on the housing stocks. Anyone own any housing stocks or builders or uh, any ETFs or mortgage servicers? I think there is two ETFs, ITB I share, the another one is XHB. XHB is a little different, but that was also up like 5.18%. TOL, is that Toll Brothers? Toll Brothers. See, all housing stocks were kind of up. I heard about a company yesterday. Let me ask, does anyone own that? NVR. This is a home builder in US. I think I've not seen much of at least in Bay Area, I don't know if they are very active in terms of construction, but this damn thing is like $7,000 worth stock. Anyone owns this? Looks like this has been like one of the compounders in terms of the stock market returns. Look at 5-year, almost 100%. Wow. Right. Starting at 87, it's like almost up 75,000%. I didn't expect that a home builder is such a could turn out to be such a great investment. This is something I want to put it on my watch list. and study why is it such a great company, stands out. I would say, let me just also say TOL. What are they looking at? Yeah, I mean, way more than TOL was also have data from 1987, almost last 30 years of data. NVR is better than TOL. Give me some more Lennar. Same is the case. Fine. So something that NVR is doing which is better than the other home builders. An interesting stock to follow. Anyway, coming back to this. So good news around the mortgage and I guess all the services, etc. Coming on the tech side, we saw Alphabet, it surpassed Apple in the market cap. I think happened first time after 2019. So now, right now, Alphabet is second most valuable company behind Nvidia. So Nvidia is getting closer to $5 trillion. And now we are looking at, let me see, market cap. I don't have it here. All right, so let's bring market cap. And right now, I think the Alphabet is number 2. There we go, market cap. Yes. Doesn't seem to be right. Okay. Right. I don't think this is the right data currently. On think or say maintenance issues looks like. Let's look at some other source. Hold on, let me go to stock analysis. SPY. It should have the data of holdings. Where's the market cap? Yep. Let's go to summary of Google. So we are looking at 3.98 trillion. This is the right number. So NVIDIA, 4 trillion plus. Google is almost 4 trillion. And let's look at Apple is 3.83 trillion. So we've been following Google for last, 3 years, ever since, they got screwed up during the first initial launch of Bard, right? And I was looking through the history of Google. Looks like Sundar Pichai had announced foreign AI in 2015, but they never capitalized on it. It was mostly a research project. Only techies were working on it. I don't think product managers paid a lot of attention to what the technology would be. But in 2022, after ChatGPT, I think that they realized, oh my gosh, this could be a great consumer product. And Google's all products are consumer-facing products, right? And I guess then they tried to put together a consumer-facing chatbot, which was a flop. Bard, I remember, I think it was a 2023 when they did it, and the stock had tanked like 8%. Thinking, okay, Google cannot figure out this AI stuff. And then financial media was all around. The 10 blue links are dead. If we heard Brad Gerstner and these, I think on B2G pod or even an All In, they were all writing obituaries for Google, saying, hey, they missed the AI boat, and now all the traffic, instead of a search, why would you search if you can directly get an answer? And if you don't search, then how is Google going to make money? This is despite the fact that quarter after quarter, Google search revenue was continuing to go high. But then we also saw Sergey Brin came back. There's an interest. I think I don't know where he was invited as I guess, a as a guest speaker in Stanford, where he talked about why he came back and what he did. He came back to coordinate all the AI efforts that were happening in Google, and then we got a first version of Gemini in December, almost a year later, and then in August 2025, we got Gemini 2.5 and Nano Banana, and that changed the whole trajectory in terms of the market perception of what Google could become in AI space. Right? And the Gemini models were on top as like number one models on some of these websites which compare different LLM models. I think LLM Arena is one website. There are a couple of few websites which runs tests and compare which models behave, and basically they score the models. And Gemini was like number one, 2.5, and now we have Gemini 3. So market suddenly woke up to potential of Google, saying, oh no, we cannot write it off. They got a depth of engineering talent, and now we also got a right leadership in Sergey Brin. So Google will figure it out in terms of AI. And then we also saw relationships. Google, I think Apple formed a relationship with Google that they're going to use Gemini as a backend for Siri, so on and so forth. And then rest we see. If you look at Google, it's been a great ride. GOOGL. Like coming back to July, August. This is where we are in August. Right? It's been pretty, I would say, nice jump from where it was around August. It was around $200. Right? And to almost 128, almost 60% jump from last August at some point of a time. And this we're looking at during a Liberation Week, it was available at $140. Oh, those were the days. Hopefully someone you picked some, but there you gotta believe in have a vision around that. Don't write Google off so soon. They're still growing their revenue. It's still a great cash flow machine.
Yeah.
And writing obituary for this company was too premature. And now they approved it. Now I think it hit, this is a new all-time high, I guess. It's not just 52 weeks. Yep, on Friday it hit a new all-time high. Any Google shareholders here?
Yes.
Great. Uh, So that worked out well, I guess. A happy shareholder. Right. So again, I think that the lesson here is, I don't think even the great investors, though, who are like, if you look at Altimeter Capital, they're crossover investors. They invest in private startups. They don't do angel investing, but let's say series A, B, and later on, right? Growth investing. And they're also doing public investing. And folks are smart. They're like damn smart. Brad Gerstner is a very smart guy. But then even they get wrong. They wrote off Google. Bill Gurley, he's a venerated VC in Silicon Valley. And I love listening to Bill Gurley. I love listening to Brad Gerstner. But when it comes to investing, you got to make your own decision and build your own conviction. Because if you don't decide whether you want to hold Google or sell Google, either case, you will never have a conviction. Anyway, so I guess, at some point of time, Google became my biggest single, individual stock position, but now it's number two after Melly. What did we see this week again? Meta. Meta. I guess a lot of us also hold Meta. Meta announced a deal with for nuclear energy deals, and we saw some of these nuclear energy companies they jumped double digits. So we saw Oklo, Vistra, and the that utilities sector, XLU, which as far as I can remember, if I forget the last 2 years, it has always been considered as, a grandfather ETF. Hey, all you need is a sustainable, regular dividend income. There's not much action happening on utilities. There's nothing growth in utilities. You pay your bills, and these are regulated companies, and no volatility, and steady state. You collect dividend and live your life. Not in last 2 years. XLU um, had been growing, and maybe I guess it with mid of 2024-ish. Ever since we realized that to run these AI, all the spending that we plan to do on AI and on chips, etc., you need energy. You need electricity to run those chips, and we don't have energy. And ever since we realized the gap, these energy companies have been through the roof. Vistra is there, GE Vernova is there. And then along with some of the established companies, all these new age, I would say, um, uh, SMR companies, small modular reactor companies, all the companies on the fringes of nuclear energy also got a good boost. CEG, that's a Constellation Energy, right? So yeah, if you have taken some stakes on these, probably it was a good Friday. And let me see. Oh, there I think I have a watch list for some other nuclear energies too. Let me just bring that up. And there we go. See, wow, Oklo, Eli, you have no idea what this is. This is Constellation, SMR, and then CCJ, which is your uranium. And when it comes to nuclear, along with nuclear, all the uranium companies, uranium miners, refiners, and they all went up. Unfortunately for me, the meta didn't go high, but hey, it's a long-term game. Meta has been in 2025. Meta has been a laggard when it comes to the performance of so-called Max 7. I guess Meta was up only 5%. You know, it grossly underperformed S&P 500. So maybe this is the year when maybe some of those that had underperformed could now, because they are available at a better and the cheaper valuation, and if we can continue to post some earnings growth, maybe we should see interest coming back in companies like this. ALB is, I think, Albemarle. ALB, Albemarle. Yeah. And I don't know, I mean, the revenue is going down. The stock price was up like 80%. Right? So I don't think any of these companies, again, I'm not going to invest blindly in any of these companies. Sometimes the stock run too far ahead of where the business is, and when the tide goes out, those are the stocks that will correct the most. You still need to look at, hey, what's the business that they are in, how are they running the business, so on and so forth. That the standard filter criteria that we apply for businesses. So third thing we also saw was the defense sector. I think defense went through a little bit of a roller coaster ride this week, with the comments coming from administration. I think the first comment was we should limit the buybacks and the executive compensation and the dividends which these defense companies are paying. And then the stocks went down. And then another comment came that we propose to increase the spending on defense by almost 50%, from $1 trillion to $1.5 trillion. All the defense stocks went up. Right. So these are some of the defense stocks, and you look at a year to date change, right? I mean, AeroVironment, all the changes came in this week. It's up like 50% for the year. If you're 100% in this, you're done. You're done for next 2, 3 years. Rocket Lab, L3Harris, LMT. Even if you pick up the ETF, that's up 8.5% for in just this 1 week. Anyone own some of these defense stock? I don't have any position. I think I have a Boeing. Other than Boeing, I don't have anything else. I guess nope. I don't have. Yeah. Ramesh is saying GD, ITA, BA. GD is General Dynamics. ARC, sorry, Rocket Lab, XAR. XAR is which one? XAR. Oh, that's a Oh, this is also aerospace and defense stock. So 64% up. How about ITA? How much? 60%. Okay. See, I did not know about XAR. KTOS. Why KTOS keep coming up? In one of the chats, somebody asked me about KTOS. Yeah, I think I looked at KTOS on Friday. Not a great business. Hey, but stock is running. Right? Stock is running. What else? I don't know. Sometimes you feel it's too much too soon. You got like 20% or 50% profits already, but only time will tell. And not only defense, we also are seeing like semis are on fire, right? And these are like year-to-date change. Lam Research, I know some of you own Lam Research, that Intel is up like 24%. This is a stock that was given up for dead, until White House came and took 5% stake in Intel, and now any tweet coming from Donald Trump will just prop up the stock. We're looking at Intel is now trading at $45.
Vivek,
And yeah.
sorry, can you finish your thought first?
Now I said, and I remember talking about Intel when it was at $17, when it was trading at price to book value of almost, I think 0.7. Like, okay, I think this is a stock to buy, and I added a position, but I have no idea. Like from 1745, who knows? Like, but again, my thesis is still the same, which I've been maintaining consistently. Is it's a strategic asset. When manufacturing chip becomes as important as having nuclear warhead, governments will find a way to build those capabilities. And other than, I mean, the only US company that can make chips right now, the biggest one is Intel. However bad it may be, but it is the only company we have. And then we saw government actually taking a stake in it, right? So I'll still hold my position. And I guess one of my covered calls is now in the money. I think I'm at 44, but we'll see. Then ASML,
Oh, excuse me. Can I interrupt
yeah,
now?
go ahead. Go ahead.
So my mom invested in solar when Obama was you were here. So she invested in solar when Obama. Oh, well, actually, it was before you were here, but invested in solar. I think it was Solarium or something like that. But the thing is, I think the company went belly up or something like that. And
Look,
I just wanted to tell you, I mean, I don't know how to buy and sell any longer, so I just hold it. But I wanted to. That's what I'm saying about Intel. And isn't there these American companies kind of like sorry, TSMC, or sorry, like what's the other one? Honghai, Foxconn.
Hmm.
They do chip building elsewhere, or uh well, that's it.
Yeah. So yeah, solar has been a tough market, even with the I think all the support that we got from Democratic government. Um, it's all dependent on government regulations and then what's the China is doing. So solar industry got annihilated from cheap imports coming from China. Right. So, and this is a problem if you invest in individual companies. Companies go belly up all the time. And this is why if you don't, if we are not tracking it, not regularly reviewing the earnings of the company, not seeing what the company is saying in investor day, no shame in buying ETF. At least ETFs don't go belly up, don't go bankrupt. Individual companies go bankrupt all the time. There are more companies that have failed and have gone bankrupt than the companies that have actually become successful. That is why some of the short sellers, they still make money because there are more companies that actually whose stocks actually go down to zero. But we don't have to play that game, right? So again, that's a individual company. I don't know what had happened to that company, but overall, solar industry, I know like some of the companies are done well. First Solar has done well, but overall, the solar industry has been challenged. Now coming back to the chips, ASML, it hit a new all-time high. Then now it's at 1282 or something, ASML. And what a great company, 1282. It hit a new all-time high in, I think, okay, if you know ASML, it's got the EUV technology, which no other company has, even though we heard, I think in the start of December, that China has done a prototype of it. They have basically reverse engineered some of the older machines, try to create a UV, but there is a huge difference between prototyping and industrialized production, right? So there will be many more years of that gap. But I'm a happy shareholder of ASML. We've been talking about ASML for almost 4 years. I think I first bought ASML in either in 2019 or 2020. And it's not been easy to hold these individual stocks. Don't get me wrong. I mean, just that the stock is hitting new all-time high, it doesn't mean that the ride has been smooth or ride has been successful. The stock was down, had a drawdown of more than 40% multiple times. And let me just share the tweet. I think I did share it. Where did I go? But I still love the company because it's a great compounding machine. So when did I bought it in September 2020, first time. And why I love the company is it's greatly capital efficient. If you look at its return on invested capital, it's like 40%, right? It means it is able to earn a lot more above its cost of capital. It's got a monopoly in EUV, and that shows up in the margins. And their margins have expanded to almost 52%. Then, like, earlier, 15 years ago, they were average was 14%, 46%, now 52%. You got a massive AI tailwinds. If there is any fabrication, fabs, Global Foundries, TSM, Intel, they all need ASML machines. And then it generates tons of cash flow and also buy back the shares. Right? So is it easy to hold this? No. Looking back, looks great from 370 to whatever, like almost or close to 4 times in 5 years. But it is not great because it was down 40% multiple times. To look at ASML, hopefully I have a drawdown chart. Let's go back and look at 5 year, right? This is 40% drawdowns. One, two, three, four, five. There are multiple times when it was down 40%, and some part of a time it was down 60%. It becomes very, very difficult to hold through these if you do not have your own conviction behind these, right? So that's why I focus a lot more on understanding the company and building your own conviction. It goes both ways. Sometimes you could be wrong. I mean, I still hold Teladoc in my portfolio. Anyone wants to look at Teladoc? Any Teladoc shareholders? I'm looking for a shoulder to cry on. Anyone? Anyone with me? Oh, Rajiv is there. See, I'm having a little friends in misery. I still hold this. It has become kind of a dust in my portfolio. Is down 97%. Drawdown of 97%. Uh, Stupid. I didn't know why did they buy Livongo. Wasn't focused. The way I'm looking at a company is when I bought the Teladoc, given what I know now, probably I won't touch it, right? But there are companies. But I only think one thing I know is that it will not go to below zero. So I'll still hold it and sell it when I need to do a tax loss harvesting. Unfortunately, it is sitting in my retirement account. So I think I have some shares in my regular trading account as well. Will use it for tax loss harvesting. But max it would go down is zero. Right?
How
But
how
if
how
you,
is different from when you go see a doctor these days you have televisit, right? They are not actually using the teledoc at all, right?
which one?
When you go to see doctors these days, you can have a virtual visit, right?
Yeah. So Teladoc basically, like Ramesh has mentioned, it became a rocket ship during the COVID because they had a telehealth solution. Right now, there are many such telehealth solutions and not just like appointment, but also, you know, then you can do messaging and all that stuff, basically allowing doctors to manage to do a patient care through remote. And I think the biggest mistake that they did, they wanted to expand just beyond that because I think the writing was on the wall that telehealth space has become very competitive. Even in 2020 or was in 2021, I saw another company came up which called Amwell into a similar space, but much smaller company. What that mistake that telehealth Teladoc did was go beyond its circle of competence and do an acquisition of Livongo, which make these some medical devices. I forgot, was it blood pressure monitoring or there was some. And then they also bought another company called BetterHelp to focus on mental health care. The Livongo acquisition is one of the worst acquisitions of any company that I hold in my portfolio. That would take, or I think they bought it for 16 or 17 billion dollars, somewhere between 50 to 20 billion dollars, if I remember correctly, and then to write off most of that investment. Pathetic. This is what happens when companies just try to expand their you know area of influence. CEOs want to conquer more and more territory, and for a shareholder, it was the worst decision.
I have one like yours that I've been holding forever, right? Under Armour. It's
Are you
literally
a
worth nothing these days. I'm not gonna sell it because it's not worth nothing right here, right?
yeah?
So
So same is the case. Oh, come on. So same is the case with telehealth. I'm like, what do I get even if I sell this? Like this is not even a 0.5% of a portfolio. It has gone so much down. I'll let it sit around. I have a few more, so some companies which are down like 70%, 80%. But if you, uh, I have no conviction on telehealth, but just that it is so low, it's just sitting there. But if you have a conviction and you find a good company and you hold it, all the losses of Teladoc And let me also add the other one, which is DocuSign. The losses from both these companies were down big, have been compensated just by ASML. Because the compounders can continue to grow, right? They become 100%, 200%, 300%. You can get 10,000% return if you hold a good business. Max you can lose unless you're leveraged. If you hold a bad business, is 100%. Right? So for me, yeah, I'll just hold it. I mean, if I had known what I know today about companies and focusing on, following it every quarter, I bought this when I was still working, right? So I didn't have a time to follow quarter by quarter or do a better analysis, which now I can do because now I'm doing for full time. I would have sold Teladoc earlier, but now it is already so down. I'm like, yeah, let it let it sit around in my portfolio, right? So looking at S&P, leaders and laggards for it year-to-date return. Sandisk, Lam Research, Intel, on semiconductors. A lot of our semiconductors. What happened to Moderna? I think majority are all semiconductors. Then we got Moderna, and of course this is Lennar. But on the laggard side, First Solar, GoDaddy, Datadog, Autodesk, Arista. I hold Arista, but I still like the company. What is CSGP? Anyone hold CSGP? I think isn't this one of those credit rating agencies? CSGP? No, there's a CoStar. Either this is related to real estate or something. Marketplace services around housing properties. Yes. So, yeah. Was there a comment? Thomas Singh Moderna has been mentioned occasionally as a bailout candidate by Big Pharma. Was that the reason why it jumped? I know, I think there was another one. It was a No Nordisk or the Eli Lilly, whoever has got Wegovy. I think their pill was approved, so that stock jumped. I
And
have
Novo
not been.
Nordisk? Say Wegovy?
Yeah, Wegovy
Yeah,
is
well, that's Novo Nordisk, right?
Novo Nordisk one, right? There are two companies, Novo Nordisk and Eli Lilly. I always get confused between Manjaros and the Wegovy. Few.
Monjaro, Zepbound is Eli Lilly. Wegovy is
Yeah.
yeah. So,
Yeah.
but there's a
Top.
company I'm trying to buy right now. It's called Wave, right? Wave Therapeutics or Wave Pharmaceuticals. They produce the newer generation of Wave GLP-1, I think oral. But it's keep on going down. I keep on buying, it's keep on going down. It's like, crap, do I buy it? Do I just, you know?
What's the ticker?
WVE. V as in Victor.
Victor.
Yeah,
Wave
Wave
Life
Life
Sciences.
Science. Yeah.
Wow.
Excuse me.
A stock that has fallen 50% can also fall another 50% and then can also fall another 50%. So I don't know.
Yes.
Yeah, I mean this whole life sciences and the biotech, etc., is too hard pile for me. So I don't want to own any of these individual stocks. I don't care where the stock is going. Uh, Too hard pile for me. And that's what happened. Okay, I'm not going to touch these individual companies. If I were to take an exposure, I think XBI has done well. Unfortunately, I wasn't positioned in biotech ETS, but over the last 1 year, XBI has done pretty well. Again, I think the whole idea is that because of use of AI, they will be able to have a faster time to market when it comes to the solutions. Either when it comes to the pharma, you should be able to simulate how the medicines will behave using AI and reduce the time that you do in your clinical testing and all that stuff. So a lot of AI tailwind over the last 1 year has come on, that's propping up this biotech sector.
So
But
I have XLV and it's doing pretty well. How is
yeah,
XBI compared to XLV? Which one is
XLV
better?
is again healthcare. So healthcare is one sector which actually
But
added
I'm saying
jobs.
from a chart perspective, you put them together, which one has a better curve?
Let's compare XLV. So this is like overall healthcare, and then XBI is a biotech. Let's go
Yeah.
for last 1 year. Right. So you're still looking at a last 1 year, like biotech had done better. And biotech is generally more volatile. So I don't know, maybe let's go for the last
Yeah, like
5 years.
Regeneron, for example, right?
Yeah,
Up and down big time.
let's go for last 5 years. Biotech, it's actually still down for the last 5 years. Yes.
Hmm.
It is still negative 16%. Biotech gets its seasons when you have loose monetary conditions, and because they always need funding, and now the tailwind of AI. And when the monetary conditions are tight, biotech generally doesn't do good. That's what we're seeing in, like, I was in 2022 hasn't done nothing for almost until for the 3 years they've done nothing. All right, few more discussions around. Nice comment, Tom. On Dave consistently picking the stocks that are going down. We need to have an inverse Dave then. Like you have an inverse Kramer, then we need to have an inverse Dave. All right, so this chart that I want to show actually surprised me. Is over the last 3 years, we had, we have had a great markets, and I was like, come on, is that all coming from multiple expansions of AI tailwinds and all that stuff? But I saw two charts on Twitter. Uh, this is coming from Goldman Sachs, 2020 to 2025. Majority of the returns have actually come from earnings growth. Cumulative since 1990. Again, 8% out of a 9% returns of the stock market S&P 500 are actually coming from earnings growth, not from multiple expansions. So I really wanted to focus on this 2020 and 2025 because that's the closest to where we are right now. And it looks like it's, even though I feel the markets are high, but hey, it is justified. Right? They all are coming from because the companies under S&P 500 in totality, there are companies that have done worse, but there are companies that have been great businesses to own. So overall, S&P does deserve where it is right now, despite the fact that we had 3 consecutive years of plus 15% growth, like 2023, 2024 were all plus 20%. And now in 2025, we got close to 16%. And then there's another one which saw from Carson Group of 2025. So 2020, this is, I think, including dividends. So they're looking at of 17.9%, which is including dividend, only 2% came from multiples expansion. Everything else is justified coming from earnings or by returning capital to shareholder in forms of dividend. So I was, a little more skittish right now when I entered into 2026, saying, come on, guys, we already had a great 3 years. And how long can it continue to go up? But when I saw these couple of charts, I'm like, maybe this is justified, right? We haven't yet seen the conditions, unlike if you go back in history and look at, maybe there is a comparison, it's a favorite pastime trying to compare RV in 2000. If you look back on the 2000 versus what the condition right now in terms of where the returns are coming from, it's very different. There's a lot of returns in 2000 which actually came from multiple expansions. And look at companies like Cisco. Cisco just, I think last year, it took it 25 years to get back to the same stock price which it had in year 2000. 25 years to surpass the peak of 2000. Right? So I guess we are still not there wherein that it's all because everyone is all in, and it's all coming because we're willing to pay higher prices for the same business than what we were willing to do earlier. That's not the case. It is, 2% growth out of 18%. Yeah, that's small. Right. So I'm like, okay, I think I need maybe maintain the same level of deltas. I was actually starting to think that maybe I should reduce the deltas in 2026 in terms of what I overall want to maintain. But this was completely different than what my thinking was. And I have to go with what the numbers are, right? I might feel differently. Right? I feel that I should not have, I feel that I should have a lesser deltas, but numbers are numbers. Numbers don't lie. And that is why I love looking at the numbers, because hey, these are the objective numbers. Companies, these numbers are deserved. These are deserved. So anyway, so then the question is, how about the Q4 and 2026? Because this is past, this is history. And in 2025. Today, if I'm looking at it, I need to look in what's future, right? If you guys we are investing today so that we want to know how it's gonna perform in future, what's expectations on future. So Q4 results it'll start to come from next week. But currently the Wall Street consensus estimate is 8.6% growth in Q4. 8.6% as compared to Q4 of 2024. And tech side, which is the majority of S&P 500, almost, we say that those big tech companies are 40% of S&P 500. That sector is estimated to grow at almost 26% quarter over quarter. And if that's the case, then it's not too expensive. And now looking at 2026, these are the Wall Street average projections for the earnings growth. Tech is like 30%. Right. Overall, S&P 500, I think last week I mentioned, is around 15%. It's like 14.6%. So when you're looking at a consortium of companies, which is able to grow its earnings, projected to grow its earnings by almost 15%, then where it's stats. Then looking at this, I'm just trying to figure out what's the forward PE for S&P is. Currently it's 26. Doesn't seem to be that out of date. They don't have a forward PE here. Oh, come on, somewhere they should have. Nope. Let's go to S&P forward PE. S&P forward PE. We are looking at 22 forward PE. That doesn't seem to be too expensive. For the collectively, if we are growing our earnings by 14%, then paying 22 times earning, not too expensive. Right. So my whole thesis around maybe I should become a lot more defensive this year has been proven, or at least these charts have demonstrated that no, I was wrong in my thesis, in my thinking process, and then I have to, you know, make sure I change how I was planning to manage my portfolio. So you do what you want to do, but I really wanted to share this because it changed my. I was thinking opposite. I thought a lot of stuff is driven by growth in multiple, because we're planning to look at, you know, liquidity. We also know that we're gonna get tax cut. You're gonna get bigger refunds and deregulation, interest rate cut happening in next year, this year in 2026. So I guess investors are willing to pay up more, bigger multiple for their earnings. I thought that was driving markets where it is, but nope. So far it's justified by the earnings. So that was an eye opener. I guess I'm still looking for some more data related to it, um, and but this was a different than what I thought. Tom is a QQQ hasn't made a new high since 1029. That is correct. We had a Russell made a new high. We didn't have even, I don't think S&P has made a new high. Yes, S&P did. I think on Friday maybe made a new high, but we didn't have QQQ. I mean, some big companies in QQQ like Meta hasn't performed. Tesla hasn't performed. Like Netflix is down 30%, so on and so forth. I'll say some water. Then we'll get into surviving the market crashes. So I think this came from our discussion last week in terms of a strategy of building cash reserve. But then I added some more content into it in trying to think through, especially those who are uh, not in retirement. Maybe I should not say in retirement, but if your sole source of income is your portfolio, then how should we prepare ourselves for bad times if it comes? I think some people think that, and some of my friends say, "Oh, you don't have a job. Oh, it means you're retirement." No, I'm not retired. Bloody, it it consumes a lot of time. It's not easy, right? I spend more hours working than what I used to work for others in my job. But people think that if you're only investing, you're kind of retired. It's hard to fight that notion. But anyway, before that, any other thoughts on the market? What else did you see in market? I'm only one person, and I don't focus on markets too much. But these are some of the things that I thought I found interesting. I thought I'll bring it up. What else? What did I miss? Some big stories of the markets.
Hi, Vivek. I
Yeah,
don't
Shri.
think you're working. You're just enjoying what you do.
Yeah, people think that I'm retired. I mean, I hear from, very people close to me, they're saying, what the heck, you're retired? I mean, no, I'm not retired. Because they have a notion of, hey, why did you retire early? You're not that old. You should go and work. I mean, dude, I am working. Uh, just that I think society, socially, we think that if you enjoy your work, then it means you're not putting in your 100%. But I don't know why we have to take too much of attention and all that stuff. Then only people think, okay, you're working your butts off. If you come home smiling, then I mean you're not even working. But it's a difficult to fight that notion. Yeah, like Warren Buffett says, right? Tap dancing to work. I mean, we all should be doing that. There have been times where I had to work just because I needed money. But there have been times I worked because I just enjoyed my work. I loved working in the job that I was, and I would have worked even if, they would have paid me less because I loved late. Sorry, I loved, enjoy working in that one. But there have been some times where I said, no, 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 I want to build, especially when I was trying to focus a lot more on investing. I'm like, okay, I'll keep my head down. I want to build my, parallel passive source of income. And even if I don't enjoy this job, it is giving me salary to pay the bills and to build my portfolio before I can say goodbye. And yeah, it sucks. It sucks. Suck it up and do it, which I did. Right. But then some part of the time we decided, okay, hey, now I want to go back to the work that I want to do and enjoy. Anyway, all right, so let's talk about market crashes and surviving market crashes. If your only source of income is your portfolio. Right? The best time to prepare is when everything looks rosy. If you are a startup company, the best time to raise funds is when you don't need it. Or when the markets are great. Even if you don't need it, if the markets are great, go and raise funds. Right now, the weird markets have delivered 3 years of spectacular returns. Everyone's portfolio, even if you have not taken any individual stocks, even if you have been completely passive, have slept through 3 years and let your 401k go automatic distributions into S&P 500, you come out really well. Right? So maybe it's time to look at and prepare ourselves for, hey, what if the tide turns around? What actions or what are the thought process that we should go through in preparing our portfolio, right? So idea is, hey, and I just picked some numbers. There was some withdrawal rate that we discussed a couple of weeks. If you own a $1 million of portfolio and 4% is generally financial advisors will say you can safely withdraw it. And then assuming that $40,000, you are able to live your life, assuming whatever the other income you might have. That should be enough to survive, right? Because on an average, S&P gives returns, 10%. And but the returns are not always like 10%, 10% every year. Even though the average is 10%, I guess there have been hardly 1 or 2 years where the S&P has actually delivered 10%. This is close to 11. I'm looking at 10.9 is close to 11. 1993 total return, this is total return, it includes dividend, was 10%. Right, what else is closer to 10%? Probably nothing. 10.8, 1968, maybe the next closest in the tens. Right. So the question is, if we build all our calculations on S&P gonna return 10%, I got $1 million. It's continued to grow 100K for long term, yes. But we don't know what could happen in a short term. But if we build our own thesis and how we want to manage our portfolio, set up for our retirement, or withdrawing your income based on this assumption of 10%, we might be jolted out of our sleep. Because we have seen 6 feet tall folks will drown in a swimming pool that is 5 feet deep on average. And we've also seen a lot of investors that have lost their fortunes, lost their all retirement, trading in where I have S&P 500, which on an average delivers 10% return. Why? Because we got a drawdowns. We talked about the drawdowns of ASML. Like 40% drawdowns, multiple 40% drawdowns, 60% drawdown. But if you look at, let's say, ASML and look at his CAGR, probably comes out to be pretty good. Right? Then I can say, oh my God, ASML delivers 10%, 50, I don't know how much the CAGR is, but let's assume that it's a 15% CAGR. Hey, go all in into ASML. 15% CAGR. What else you need? You got $1 million, put in it. You want to make 150K. Life is set. But not when you have a drawdown of 60%. So the question is, and now this is the real data of S&P 500 total returns, right? And there's only 1 or 2 years which actually had 10% return. And if you're looking at the dispersion of returns on the stocks, smaller the holding period, bigger the dispersion, right? 1 year, the stock could have done more than 50%, and I guess this is 33, 35% down for any 1 year period. If you increase your holding period, the dispersion slows down. That we all know. That's why the average comes out to be, over a long period, average comes out to be 10%. This is what keeps me up in the night. Because right now I'm in a situation where I have to survive on portfolio income. If I just focus on 10% plus add a 5% icing because of all the hedging and the option stuff I'm doing, life will be set to pay the bills. Right? May not be to fly private or fly business class, but a life is set to pay the bills and maybe fly coach. But what keeps me up in the night is this concept called sequence of returns. And this is what I've been trying to simulate and see, what if for next 3 or 4 years, what else could happen? How do I position myself? So again, to explain the concept, let's take the same example. So far, everyone following? Any questions on why, we're digging deeper into this? So this is not any individual stock, but this is a lot more at a portfolio level and positioning yourself to survive in any kind of a market.
This is your ICSH?
Sorry?
This is your ICSH parking?
No. This is an overall portfolio. ICSH doesn't move, right? So there is no drawdowns in ICSH. I'm saying if you have an overall portfolio of $1 million, 4% withdrawal rate, you are able to survive. And then you increase the withdrawal by 3%, per annum. So I just ran some numbers, right? And, I will like for next 30 years. So if we average this out, I have to run some simulation to make sure that the average is 10%. So let's say we are sitting in we finished 2025, now we are sitting in 2026. You start with $1 million. And at the start of 2026, you withdraw $40,000. In next 2027, at the start of 2027, you withdraw at 3% inflation, and then 3% inflation, then 3% inflation for next 30 years. Okay. Now, these are the returns that S&P has done. And if we add up all these returns, it turns out to be 10%. So kind of a simulated what an average return of S&P 500 is over a long period of time. And I'm thinking, I think given my life expectancy and all that, next 30 years I need to plan for, seems to be pretty good. If I start with $1 million, I would leave, $4 million for my years, right? With S&P 500 giving 10% average returns. So far, so good. But then the question was, what if the returns are in a different order? What if the returns are in this order? If you add up all these returns, it is still 10%. So when we talk about average returns and all that stuff, right? This is where we miss the concept of sequence of returns. And because right now I'm like, the difference between these two returns is, when I was trying to find these numbers, my logic was first 4 positive years, first 4 negative years, then distribute the rest to make sure it gets 10% average. There have been times when we had 2 year, 3 years of bear market. Come on, let me just put in some 3 years of bear market. And on an average, in 30 years, I'm still 10%. I'm running out of money in year 19. Then, your whole theory of me, okay, guys, I think S&P gives 10% on an average. I can add in some additional options income and I think add another 5%. Maybe I'll able to make 15%. That goes out of the door. The whole logic becomes flawed if I don't think about, or if you don't think about sequence of returns. Right? Because we are also having consistent withdrawal. And unfortunately, if you retire, Tom said, take the ground bus. Yeah, that's what. If you because there's no additional income coming in, and you need to withdraw to survive. Right? If you hit into bear market, right? We had great bull market so far, and if I made money, I'm gonna retire, and then you hit a bear market for the next 4 years. Choose you because you're also withdrawing from money. You already have a portfolio that is dwindled down so much. It is almost impossible to catch later on. Right? Same average returns, 30, both investor A, let's call it investor A, oops, and let's call this investor B return. So both have same returns. So if you are in a party, we can talk about it. How much did you make on an average over 30 years? 10%. How much made you? 10%. But a condition will be vastly different. So the idea is, and this is where I said, let's build the base to figure out how to survive and come to the same topic that I touched upon last week was 4-year cash reserve strategy. Right? I don't think, maybe I'm becoming too pessimistic, but I don't know if we had a 4 year of negative returns. I mean, we had in 1929. Probably not going to end up into that same situation because we did not have FDIC, we did not have SEC, we did not have many of the protections that we have now. Fed is very prone to inject liquidity, but we had in 2000, we had 3 years of bear market. We had 2 big years of bear market in 73, 74. We had 37 negative return in 2008. Right? So let's go back to the blog that I touched upon last week and understand. So basically, this is written by a couple who retired in April 2000. What a worst time to retire. Just in April 2000 when the dot-com is just, I think it hit the top in March 2000. Oh, that's the April's worst time to retire because we just hit the top. And obviously they went from being a big wage earners to just living on the funds earned from our retirement account, right? And the moment they retired, in next 2 years, the market was 3 years, the market was down more than 40%. Right? They had to survive not only this. And then in 2008, again, 2008, 2009, that financial crisis, the market dropped 50% from 2008 to 2009 again. So the question was, how do you survive these? And what the strategy that they used? And I really liked it. You can tweak it to, whatever you want. Instead of 4 year, you might want to do 3 year. But I want to share in terms of if we are only dependent on our portfolio, this is something that you may want to look into. Okay, seriously. Because we don't know what markets will bring. Right? All of us have a recency bias. AI is great. Right? Unless, until the DeepSeek kind of a stuff comes around and all the AI stocks are down, markets are down. We don't know what might happen next year. So first is preparation. before you decide, okay, I'm gonna say goodbye to my job because I made great money in last 3 years. I think over a 10% average return I can survive. Start preparing. You should start building your cash reserve, invest money in money markets, ICSH, SGov, CDs, whatever. Liquid cash that you can access. When I say liquid cash means almost equivalent to cash, it's not dependent on where the market is going, right? The goal is to save 4 year worth of expenses. Or now if you think 4 is too, I mean, I will just pick from this blog. If you're saying 3 years, change it to 3 years. Thought process same, but because you're thinking, hey, I think 3 years, we don't gonna have a bear market for 3 years. Keep it 3 years. The living expenses means all the expenses that you need to live from your portfolio. So if we are actually retired in terms of our social security, right? You're getting your then you're getting social security, or if you have a pension, right? Then you don't need to withdraw that money from your portfolio. So this is only what the money that you need from portfolio, that should be a target amount. If you're getting something from social security or from pension, or if you have, let's say, already an annuity plan, something that is those things that are kind of a guaranteed, right? Then you deduct that from your overall living expenses to figure out what's the target amount that you need to save for next 4 years. Okay. The method that they followed, you should accumulate, 20% per year. So start 5 years before you decide to kind of kick your job, and save 20% every year into cash, CDs, whatever. Now, once you don't have your paycheck coming in every 15 days, what are you gonna do? When the stocks are going higher, withdraw your living expenses from stocks or mutual funds so that you don't touch your cash reserve. Because the worst time, maybe we'll talk about second topic, and when the market is down significantly or crash, stop withdrawing from your stocks immediately. Which kind of makes sense, because the worst time to sell your stocks, especially great companies, is when they've crashed for no reason of their no fault of their own, just because overall market has crashed. Right? The business is still okay. Maybe they were a little overvalued. So when we're looking at a crash, we are not talking about 5% crash or 10%. That's not even a crash. That's like, hey, that happens every year. When you're talking about a crash, means your stocks are down like 30%. Just like where, let's say, Netflix is, or where, let's say, Google was. I mean, Apples have gone through many of such crashes, 30%, 40%. Worst time would be that to pay my bills, I have to sell great companies when they're down 40%. And right? So when the stock significantly crash, go to your cash to support your living expense. Remember, you have 4 years of living expenses saved in the cash. So that's what we should do when, at least they suggest. And they did was, if the market is going up, maybe sell covered calls and get assigned, keep the cash, invest it in a cash reserve. Right? Don't sell your stocks when the stock is down like 30%. And markets will go up, markets will come down. When markets start to recover, do not immediately switch. Continue to live on your cash for next few months. You never know. Sometimes we have what do you call those bear market rallies. Right? So this will, and also if you start to sell stocks immediately, and if the market continues to go higher, and then you will lose out on all the gains that. So generally after the crash, the stocks have one of the highest upside, right? It's a darkest before dawn. Right? So the big amount of daily gains, or let's say weekly gains, have come after the biggest crashes. And if the moment the stock starts to gain, if you start selling your stocks to fund your bills, then we will lose out on all the upside gains that might come later on. So wait 12 months, 18 months. After that recovery period, then you start selling from your stock funds and start to replenish your cash reserve. Right? And if market is volatile, if market falls rapidly during the replenishment phase, stop temporary, pause the replenishment and just use the cash reserve until the market goes back to stability. So at a high level, I mean, I understand. My idea is to just share the concept. I really liked it. And this is coming from a couple who have survived two big crashes that current investors would know of, 2000 and 2008, right? 1970s, etc. Very few of us probably were active in the market. We don't even have any memories of those. But this is a strategy that they used to survive two crashes, and I really liked it. Got me thinking in terms of, maybe I need to build a little more cash. You guys know I've been building up my cash position, but if I really, maybe 4 years is too much. 3 years possible. How do you survive those drawdowns is the key. Average is average, but like I said, 6 feet people drown in 5 feet average deep swimming pool. And but I don't want to be taken out in a market which on an average returns 10%. So I'm going to implement some portion in my own modified portion of this strategy. I liked it, thought I'll share with you guys. Just got me thinking in terms of when the markets are all green, nobody's thinking about any risk. The risk comes from the places where you least expect. Nobody was thinking about COVID. And then we saw market down 34%. Right? Thank God I had a job at that time. But if you did not, if you are surviving only on investment income, that's the only source of income. Gosh, selling some of the companies and 34% down would then take years to recover from it. So thought I'll share with you guys. Hopefully, some of you may have to use this because if you are only surviving on portfolio income, maybe most of you don't have to use it. Up to you. Any questions?
Yeah, I had a question. I guess if you're selling like a large like portfolio in that part, I mean, I'm thinking about taxes too, right? And so the concept that you just shared it looked like was basically when it's high, sell, when it's low, pause. But do you have any thoughts in terms of like the increments and selling it over time? It looks like the person was recommending 4 years out from retirement. So I guess it's a gradual thing that you're selling, but I'm just curious, like, you had any thoughts on that? Because I can just see like very large tax bills as a result of the strategy.
Yeah. So I think what Rios recommend is 5 years before retirement, start to build your cash reserve. I mean, if you can build your cash reserve right now, and this is why I think they said 5 years, so that you don't get hit by your tax bill, um, immediately if you have to sell everything in 1 year. And again, this is probably while you're still holding the job, make sure you build your 4 years worth of living expenses. Now, if you're only holding investment income, your only source of income is investment, it is like we're already past this stage. Right? So we have to do something different because we're already past this stuff. We're already kind of in eyes of financial planning, we're already kind of in retirement. So now we have to determine how do I build 4 year worth of cash requirement. Maybe do some tax loss harvesting. Like say if I sell some stocks, probably I'll also sell some Teladoc to do some tax loss harvesting to keep my taxes low. I guess that's going to be individual to individual, but this is before you even kick your job out. Make sense?
I think so. I mean, I was just actually listening to something on the internet around some of the ideas to reduce the tax burden when you have a high divestiture and you're getting ready for retirement. So one, you can donate to charity. There are like lots of different ways to, because do it. Tax loss harvesting is one, but just curious if there was like other things to think about. I think also you're talking about selling as options if you have a huge like portfolio in a particular concentrated area. Options would be one way to do it and on a regular cadence, but that's what I was just trying to understand, like with the strategy of like when you're
Oh, yeah.
ramping
So those
down.
are like general
Mhm.
tax saving strategies, right? Tax loss harvesting. Instead of selling stock, you sell options, but then your options could get called away. You're still hit by the tax. There is another one which is called if you have a concentrated portfolio, um, and I forgot. I think Schwab also probably started this offering this ability wherein they'll take your concentrated portfolio, they lock up that investment, and then you basically get from them is a diversified portfolio, and but there is no tax hit. So that's more of how you get out of a concentrated position, mostly for founders or execs whose all the wealth is tied into one particular stock and they want to get diversified without taking a tax hit. So there are ways on saving taxes. I think some CPA can tell you a lot more ways, uh, but this is only to focus on, hey, how do you make sure that you have enough cash available and use all the tax saving strategies that we want to use. All right, what else? Tom is how quickly we forget that from Feb 2025 to April 7, many stocks and indexes were negative 20 to 30%. Yeah, I was looking at only at end of a year data, but between years, there have been cases. I mean, it's pretty common that stocks go down 10%. Pretty common in history. Hasn't happened, I would say, in the recent times. So many new investors think, oh my gosh, stocks are down 10% and the life we gone market has gone to the dogs. No, it's a common stuff for stocks to be down 10%. Every 3 year you get a bear market, right, which means it's down more than 20%. But in between, 20% drawdown, common. And even if you hold the individual stocks, then I don't think there is any limit. So, all right. So sector wise, nothing much to complain about. We are only looking at 1.76%. Materials is on the top. Fear and greed index, we are still sitting in neutral, right? So I'm not rushing out and buying it or adding too many deltas just now, even though I'm still trying to. First, I thought I will reduce overall bullishness in 2026, but looking at how the numbers and the chart show that all the valuation has mostly come from earnings growth. So I think there's not too much of a fluff in the market. I don't not talk about individual companies. There are many individual companies. There's a lot of air. There's a lot of just gas. There's a lot of um, margin. A lot of multiple expansion without any change in business. Overall market doesn't seem to be that frothy based on the numbers. So I'm still holding um, same deltas which I was doing in 2025. So what did I buy or sell? Didn't buy anything. I had a Airbnb call at 140, sold a little bit of a shares, closed the call. It wasn't in the money just yet, but I didn't want it to have an early assignment and go then in 100 shares will get called away. I sold a little bit, and and close my call, and that also increases a little bit of my cash position. I guess that's all I did on buys and sells. Again, not a recommendation, but I do share with you in terms of what I'm doing. There was a question ICSH. So I found something else on ICSH, and I realized I did not really. I mean, I thought ICSH was T-bills and corporate bonds. Right? This was my preferred vehicle to park the cash, and it was giving 4 point some percent yield. Let's go to yield of ICSH. It gives you something 4 point some percent yield, right? And so this week I was actually looking into the details of ICSH, looking at where's its yield. The dividends 4.55, which is more than, let's say, what your treasury bill would give, which is 4.1. But then I was looking into the holdings of ICSH. Didn't like it. It looks like they have a lot more of corporate bonds than they actually have TVs. All are corporate bonds. So which was a little different, because the description I told that it holds, investment grade bonds with treasuries. So now I have to rethink.
So if you put your million here, is 42,000 right here, right?
Yeah. But this is the corporate bond. So I don't want to put in ICSH now. And I'm thinking now, where do I, because here's the deal. If market crashes, and probably these are all investment grade, but I don't want to take a risk wherein the bonds, start selling, let's say, 70 pennies on the dollar. I don't want to take that risk. So I'm thinking maybe I should swap to then SGO, because that is it is little less interest, but I have almost as close to 100% guarantee that 4 point whatever 1 or 2% will be given to me because it's backed by US government.
Vivek, this is an ultra short duration bond fund. So ultra short is like 3 months or lower.
Yeah, this is 3 months or lower.
This will never never go down to like 70 cents or 80 cents or even 95 cents on the dollar.
So I've not lived through wherein,
Those bonds,
suddenly the companies blow up. What happened to bond in 2 or 3 months? That's what in a crypto you think these things fall a lot, but I don't know. So I was like, should I take a risk?
No, it's not taking any credit risk either. So essentially, the interest rate risk is what you're bearing. And so, with a 3-month duration, there's hardly any ripple I don't think.
I mean, I don't, they hold Mizuho. So I thought
You
they
can
had
see in the prospectus, what is the average credit rating or what is its mandate for credit?
Oh, these are all investment grade bonds.
No, but if there is any mandate, it'll say whether he can go down to C grade or no.
Oh, okay. I'll have to look at that. But when I bought ICSH, I think the whole idea was that they're holding treasury plus corporate bond. I'm like, where are my treasuries? That was a little surprising. I'm like, oh, then now I have a risk of
What?
corporates blowing up, which I did not, when I got into it, I did not understand.
So the reason you are getting the extra juice relative to SGov and BND, etc., is precisely because they hold corporate paper.
Yeah,
If they
and
didn't
I
hold
knew
corporate paper, you would never have gotten it.
no, I knew that they hold corporate paper. What I did not know that they only hold corporate paper. I thought the major they had a decent amount treasuries plus corporate paper. Now I'm thinking, is the spread really worth it? Between SGov and this, what we're looking at. 50 basis points. 4.1 and like 4.5 is 40 basis points. I mean, again, this is theoretically, I was thinking through it. I know it's a short duration, so I don't have a too much of an interest rate risk, but how about the default risk?
There's very little, I think, in these ones. Also, it's ultra short, not even short. So short would be 2-year duration.
Yeah, this is ultra short. This is
And Vivek, is the tax treatment of the earnings from SCOV better as compared to ICSH, especially like
No,
California?
they are both taxable funds. If you want a tax-free, like I do, buy CMF, which is an ETF for California tax-free. If you just want an ETF, if you want in a mutual fund form, go to Vanguard. They have very good tax-free funds.
but then post-tax is almost the same, 2.9.
No, I'm getting 6-7% taxable equivalent.
It's 3% dividend yield.
Right. So if you're in the marginal tax bracket of California plus Fed equals
California plus
50%,
Fed, yeah.
50 or even for divided by 0.6, divide 2.93% by 0.6, and that's your taxable equivalent.
Yep. So it's to
At least for me, it's 0.6.
4.8. Better than
Yeah.
yeah.
And so I'm in California long-term, fund in Vanguard, and that's giving 4%. What you see here is 4. So if you divide it by 0.6,
So that would be close to 6 plus. That's like almost 6.5.
and I bought some individual bonds last year in California tax-free, which are at like 8%.
So anyway, so the whole ICSH, I was like, I may have to rethink my plan because now I have a corporate risk, which I did not. I knew that they hold corporate, but looks like they hold only corporate, not much of a T-bills. So I thought I'll share because we talked about ICSH. Maybe SGov, maybe CMF, look into it, or maybe just stick to it because, like Kevin, you are saying this is all very ultra short, and you don't have much of a default risk. I don't know. We have seen AAA issued notes or papers blowing up during 2008 crisis. So that's what got me thinking, maybe should I depend on these corporates? Anyway, so that was that. Interesting one. I'm still thinking about it. What should I hold? Should I sell? Where should I build? What vehicle should I use for my cash reserve? But on the crypto side, we had a Morgan Stanley who filed for a crypto ETF. So they filed for Bitcoin, Ethereum, and Solana ETF. Welcome, Morgan. Welcome. So we have a lot of other companies that they already have ETFs, but none of them are traditional big bank companies, right? We don't have ETFs from bank like Vanguard or Bank of Americas, or these are the Wall Street. We have from BlackRock, but none of the banks have filed. So Morgan Stanley is the first one to file it for Bitcoin, Ethereum, Solana ETF. So yes, getting mainstream. And I think the day is not far away where you should be able to buy crypto on your banking website. But there was also some conspiracy theory going around. I don't know. Do you want to get through the conspiracy? It's an interesting chatter, but we may want to discuss something else. We are already hit 12-hour mark on the West Coast. So I think that's the last one I wanted to share was a new price target from Vanek on Ethereum. Look at the bear case is 360, bull case is 154. Anyone can give this. I don't even know what kind of a research is this, where you have such a widespread, I would say, gap between base, bear, and the bull case.
Oh, he's got what, 7 years to go, right?
And in 2023, I brought up a similar report. The target was 118K. Oh, sorry.
But it's over a 7-year forecast horizon, right?
Yeah. So in 2023, they were saying 118K over 7 years, and now this is 2024 report as of May 2024, which means almost 6 years.
For 6 years now.
Yeah, they're saying 100 from instead of 118, now it become 154. Who knows? It could be anywhere. It could be anywhere between 360 and 154.
They're just doing a Monte Carlo evolution of the price curve using some
No, I mean there is a whole report. If you can, I couldn't find the 2024 report easily available on the Vanex site, but I was able. I mean, I had downloaded 2023 report and gone through what the methodology they are using. So they are using a normal, DCF a methodology in terms of ETH becoming, the yield is coming so much, ETH becoming, and then there are assumptions in terms of how much of a payment infrastructure it will take up and so on and so forth. And then they build their models, and using the DCF, they came up with these bull case, bear case, and base case. So there are multiple reports from different issuers. Each have their own price targets. But VanEck, a lot of people quote VanEck, and I saw this, I thought I'll share. All right, that's all I have. Unless guys want to get in the conspiracy theory behind Morgan Stanley. And the net is, they say, is again some tinfoil hat thesis is, hey, the crypto prices were depressed since October because Morgan Stanley wanted to buy these so that they can fund their ETF before they launch it. And then there is a timeline. Someone had put together the timeline of why it happened and what it happened. MSCI, which was earlier part of Morgan Stanley, they told the companies that hold digital asset treasuries will be excluded from indexes, and then all the crypto fell down and whatnot. But maybe we can leave that for some other day. That's all I have, guys. What else you guys are thinking? Tom say move to Nevada. Yeah. But I don't know if I can, I can survive in 110 degrees.